Hello, I'm Jamesina from the Investment Management team and welcome to the Global Macro Outlook prepared for Q1 2016 by our team here at JohnstonCampbell. Markets are particularly fluid at the moment, so even from when this presentation has been prepared, some of the details have changed, so we'll try and cover as much of the detail over the next few minutes as we can. At JohnstonCampbell here, we are multi-asset investors and therefore it's our outlook on global economic events which really shapes our viewpoint on asset classes and how we participate in them to try and source the best possible returns for our investors. In times of exceptional volatility, this quite often shifts to concentrating on risk control and thinking about the best way to mitigate downside risk without excluding the potential for upside return. We've always found the best way to achieve this is by taking a longer term outlook over 5 years. So while we are cognizant of short-term factors, we try not to let these unduly influence the wider outlook unless we feel they're giving us a signal of a shift from the most probable outcome. So I'll just talk you through some of the presentation. This first picture covers the main 3 factors dominating the global outlook at the current time, and these have really been present over the last 3 years. I won't go through this in great detail as coverage in the evening news has been comprehensive, but there's no doubt that there are strong concerns of slowing growth in China and emerging market weakness. This is affecting the outlook for global growth and has really been driving much of the recent volatility in markets. So if we consider the consensus viewpoint, actually what it is for the economy, you can see here a standard economic cycle. The UK is sitting just below the peak in mid-expansion at the moment and the US a bit further along, which provides evidence for the Fed's interest rate increase in December. In actual fact, since this data was prepared, we've had a bit of a downgrade to the GDP forecast, so we are probably a little bit more to the left than is actually shown. What I should say here is that since the introduction of QE in developed economies, the economic cycle has become more protracted, and therefore we have been in this mid-expansion outlook for some time with no real catalyst to move forward along the cycle. So if economic fundamentals look reasonably unchanged from last year, the next thing that we look at are potential risks or headwinds coming through in 2016 and then attaching a probable outcome to these risks. This is really our what if we have it wrong scenario. Firstly, China. As I said earlier, there is no doubt that China is a slowing economy, although in that context they did post GDP figures of 6.75%, so I guess it really depends on your opinion of slow. Economic forecasters use the terminology of a slow and hard landing, and what this really poses is the question of whether the Chinese economy slows at a steady and therefore manageable rate, or whether this is a sharp decline known as a hard landing, which would have much greater implications for the world as a whole. We believe that we are in the soft landing camp, and there is still enough economic data to reinforce this view. However, there is a question over how believable this data released from the Chinese authorities is, and therefore there is a risk that the situation is much worse than actually disclosed. Next we move on into the US and concerns that the rate rise in December, the beginning of the monetary tightening policy, is really a move too soon. The Fed's responsibility is to promote sustainable growth, high levels of unemployment, stabilise inflation and moderate interest rates. The economic data from the US suggests that they are in the late expansion stage, and it was time to send a signal that they are healthy enough to sustain an interest rate increase and certainly begin that incremental journey. However, the risk here is that the dollar continues to strengthen, which affects exports, and this further exacerbates the issue of outflow from emerging markets, which then circles back as an issue to the US. If monetary tightening is too soon, this could backtrack the US economy, leading it back into recession, but we think this is really unlikely to happen. This flows then on to global monetary tightening, and really the next economy is the UK, as Japan and Europe are still adopting an easing policy. The Bank of England are now giving guidance that interest rate increases won't happen until perhaps the later stages of 2017. So the adoption of monetary tightening is really just being pushed further along the time horizon. In the US as well, forecasts in December were predicting a 4-stage rate rise in 2016, but this has now been reduced to a 2-stage rise. The next big risk there is Brexit, very topical at the moment. Opinion polls would suggest a 55% probability of no exit and a 35% probability of a soft exit, adopting something like the Swiss arrangement. If they exit and the terms of that exit will affect trade agreements and likely add volatility to sterling, which could have a knock-on effect into the property and equity markets. This is really a close one to watch for this year, but until the referendum date is set and the campaigning begins, there's not much planning that can be done around it. For many of these risks, we can think about the likelihood of them happening and then position the portfolios accordingly. However, we cannot really prepare for the unknown and the risks that geopolitics give. Brexit aside, there's really 3 obvious unknown risks there at the moment. An oversupply of oil rather than slowing demand, dominated by the Saudi desire to have regional dominance over the Iranians, is a complex issue intertwined with religious conflict between Sunni and Shiite. There is no hint of resolution by the Saudis to reduce their supply to the market, and so the oil price volatility looks set to continue throughout 2016. Secondly, Putin's involvement in the Syrian conflict increases tensions with the Turks, and this crisis has no sense of abating. And finally, by the end of the year, we could have Donald Trump as US President. And I don't want to give a political opinion, so you can make up your mind for yourself whether this would be a good thing or not. This picture here represents our own economic outlook, our house view as such. Beginning in the bottom left with the depression, and if you follow that diagonal up through the central view and boom, this is a standard economic cycle from trough to peak. Again, this is something that we use to represent the probability of an outcome which flows through to shape how we allocate to different assets in the portfolios. Therefore, our central view at the moment is that global GDP will probably be between 1 and 3% and inflation will be between 1 and 3%. And we think there's probably about a 40% chance that this will be the outcome. You might find that hard to believe, since in the UK inflation is still only around 0.1%, but the actual calculation of inflation on a 12-month rolling basis would suggest that when the oil price decline falls out of the rolling 12 months, you only really need the price to stabilise or marginally increase, go from say $30 to $33 a barrel for inflation to creep back. You don't need a recovery back to $60 for this to happen. Moving on into the right, our boom and gradual reflation scenarios factor in better than expected GDP growth with varying inflation figures. In total, we would be 70% positive, represented by the scenarios to the right of the line, and this view is backed by consumption growth, wage growth and household credit all in an upward trajectory. Yes, emerging market manufacturing is slowing, but developed market manufacturing, as measured by PMI, is still positive, and the services sector, which represents about 60% of developed GDP, is positive and growing. We believe, however, that financial markets are pricing in a depression scenario, and this leads us back to trying to separate market reaction to economic fundamentals, focusing on the future. You can't ignore what is happening right now, but sometimes you have to lift your head out of the noise because you can't rationalise it. If our 70% positive outcome plays out, this should be good for equities, property, and even some corporate debt instruments. So this next picture then shows our current portfolio positioning and house view. So really how all of that economic data flows through into our thinking. We're overweight mid and small cap UK equities. This has been a position we've held for several years and continue to feel that these smaller, more nimble companies, represented by a more balanced index, will continue to perform while investors remain nervous. We're overweight to Europe. The region is lagging the remaining developed economies in their QE programme, so we believe that the programme will give a boost to equity valuations as it did for both the US and the UK. We're underweight in energy. It's hard to call which way things will move in the short term, so the underweight position is more about risk control than a lack of desire to participate in the sector. Similarly, this is the reason why we're neutral in emerging markets. Valuations are beginning to look attractive, but short-term risk is high. Low duration. This is our fixed income position, which as a whole is underweight due to the sensitivity of the asset class to interest rate movements. 65% of the position is low duration, so positioned for an interest rate rise, and 35% is positioned for a gradual reflation and central case scenario where growth remains low and we remain in a longer low inflation environment. We are neutral equities, positive property and positive active management as opposed to following any one index. I should mention as well that we are consumer focused, believing that the consumer will benefit from low energy prices and an improving economy and wage growth. Some of these stocks would be considered fair to overvalued, however sometimes you have to pay for stability.
Okay.
So this next picture charts the FTSE 100 from the 1st of January 2014 to January 2016. The level of the FTSE was about 5.9 at the time, and this is really to illustrate the journey over the last couple of years. So if we take a look at this picture, this also shows the FTSE 100, but the total return index, which includes dividend payments, over the same time frame. But we've overlaid this with some of our UK equity fund selection, which features on our investment buy list. You can see here that choosing active management has really outperformed. You can't ignore the FTSE 100. It's the index that most investors know, it's headline news, but it's important to realise that our portfolio models and even our UK exposure does not adhere to that index. And similarly then, this picture also shows our fixed income fund selection and how it performs our benchmark of FTSE gilts, and this just reinforces our commitment to active management. So that concludes our presentation for this quarter, and thank you for your time today. If you're one of our clients, you can get further information by contacting your advisor, or you can alternatively use the contact form on the website. Thank you.